It's the Real News Network. I'm Sharmini Pires coming to you from Baltimore. Just days after Donald Trump's State of the Union, where he boasted about how well the stock markets were doing, stock exchanges around the world took a nosedive between January 2nd and January 6th. It began on Friday at the New York Stock Exchange and rippled around the world to Europe and Asia, with many stock exchanges losing between 4 and 5% of their value. This was the largest such drop since 2011. Things have calmed down now, and the question everyone is asking is, what happened? And what will be the consequences for the larger economy? Joining me now to explore these questions is Dean Baker. Dean is the co-director of the Center for Economic and Policy Research and is the author of Rigged: How Globalization and the Rules of Modern Economy Were Structured to Make the Rich Richer. Welcome back, Dean.
Thanks a lot for having me on.
So, Dean, first, what's your take on what happened to the markets between Friday and Tuesday?
Well, I think the major part of the story is simply you've had a very sharp run-up in stock prices. In the U.S., at least, stocks have been pretty much on an upward track with very few downward periods from 2009, March of 2009 onward. And particularly in the last 2 years, before this downturn, stock prices had risen by almost 40%. So it's really an extraordinary run-up. So in that context, you would expect somewhere along the way you're going to get some reversal. So whether that's all at once, big falls on Friday and Monday, or that will happen over a period of time, hard to say. But it really shouldn't be a surprise to anyone that you're going to see some downturn in the market. It doesn't just go up as much as some people who have their money there might like to believe.
Right. Now, one of the common explanations, at least in the business press, was the changing of the guard of the Federal chair from Janet Yellen to Jerome Powell, who took over, and there was some speculation that, of course, both the positive wage reports we were seeing, as well as the possibility of interest rates rising, caused this drop. What is your take on that?
Well, I think losing Yellen at the Fed is a big loss to the country, big loss to the economy, because here's an economist with decades of experience in policy, certainly one of the leading macroeconomists in the world. So to have her replaced, not to knock Jay Powell, I mean, I think he's competent from what I could see, but he's not an economist. He doesn't have anywhere near the background and experience that Janet Yellen did. So that's a big loss, but that wasn't a surprise. I mean, Trump made his announcement that he was picking Powell rather than Yellen 2 or 3 months ago. So the market's not going to respond to an event that has long been anticipated. The other items, there was a wage report. We had the jobs report come out last Friday, and it had somewhat higher wage growth than people had expected. People were jumping on that. It really was not much of a story there. There was 2.9% wage growth, year-over-year wage growth by one measure. That same measure had shown wage growth in the past of 2.8%. It's a little hard for me to believe that suddenly 2.9% is a big deal, 2.8% wasn't. That really doesn't make any sense. And other measures showed no uptick at all in wage growth. The interest rate story, the Fed has indicated it intends to raise interest rates. Very hard to see any surprises there. So all these stories, and again, since the market's recovered much of its value anyhow, I've been joking about it, people have all these great explanations for something that didn't happen.
Now, Dean, some economists have expressed concern that we might be heading into a similar situation as we saw in 2006, when there was a massive housing bubble. When it burst, it brought down the rest of the world's economy in what's come to known as the Great Recession of 2008, 2009. Except this time we've got a stock market bubble. What is your reaction to the comparison between that stock market bubble that burst and this one?
No, again, it really is a lot of sloppy thinking. And I should say, I was out there in 2006 yelling about the housing bubble, saying this is bad news, it was going to burst, it was going to cause a recession, could be a bad recession. So I was out there, I watched for bubbles. I also saw the stock bubble in the 90s. So I do have some experience in this one. What you look for is, one, stock or house prices being clearly out of line with fundamentals. That does not seem to be the case right now. Profits are high, which explains high stock prices, along with very low interest rates. House prices are high, but so are rents. That wasn't true in 2006. Rents weren't moving. House prices were. So it was easy to see that house prices were out of line with fundamentals in the last decade, that stock prices were out of line with fundamentals in the 90s. Neither seems true today. Also, the other part of the story is, are they driving the economy? Is the economy being driven by high stock prices or high house prices? That was true in the late 90s with stocks. We had an investment boom based on the stock market. People were actually, you had startups that were selling stock and using it to finance investment. That's very unusual, but that was happening then. And also a consumption boom based on all people's wealth, that people had money in the stock market, suddenly felt very wealthy, and they were buying a lot. In the last decade, we had record rates of construction. Housing starts were going through the roof, enormous overbuilding. And then on top of that, again, with housing wealth, you had very high consumption. People were borrowing against their homes. We don't see either a construction boom or an investment boom today. So if if the stock market were to fall, there's not much room for those to go down. And the other part, consumption is kind of high. So if you did see a large and sustained drop in the stock market, so in other words, the stock market were to fall, say 20 or 30%, and it stay there, so it not be a 1 week or 2 week story, you'd see some fall off in consumption. That would be a hit to the economy. I doubt enough of a hit to cause a recession, but it would certainly be a drag on growth. So I think that's an unlikely story, not an impossible one. But even if it did happen, we're not looking at anything like the recession even in 2001, and certainly not the collapse we had in 2008, 2009.
Right. And when there's this kind of a dip over a few days, and then it, of course, picks up, does it have a larger effect on the economy?
It's very hard to see it having any economic effect. If you go back to 1987, we had a real stock crash there. Stock fell, I think it was 22% in a single day. And that was worldwide, too. So it wasn't just in the U.S. It was around the world. No one to this date has any good explanation of the fundamentals. Had very little impact on the economy. The economy grew very strongly in 1988 and again in 1989. So this is a much smaller dip, largely reversed. Very hard to see any impact. The one positive is it might get people to think a little more sensibly about the stock market, because you had a lot of people, and we saw this in the late 90s too, they thought you just put your money there and it goes up 10%, 20% a year, and that doesn't make any sense. And if we got people to think a little more carefully, because the thing I most worry about is people put all their savings in the market, it takes a dip and they're not prepared for it. They need the money, so they have to sell it when it's taking a dip, and people really get hurt by that. So if this causes people to be a little more clear-eyed about the stock market, that's all for the positive.
All right, Dean, I thank you so much for joining us today.
Thanks for having me on.
And thank you for joining us here on the Real News Network.